And welcome back to the Economic Street podcast. My name is Ola.
And I'm Nicholas.
And we're happy to be back again, up and recording once more. It's been a long 2020, hasn't it, Nick?
Yeah, it's been a long time since we've done anything like this, and 2020 in general has been quite a challenging year, to say the least.
To say the least, isn't it? I mean, from January right off the go, we just had a lot of political turmoil. We started off the year thinking that Trump and Iran were about to get into it, and all of a sudden,
it's virus, and then even on a non-financial aspect, with the death of Kobe, it's all just been kind of spiraled from there.
It's been a madness, but I'm grateful that we're still here, we're still around, and we hope our viewers have been doing well and keeping themselves safe as well. Let us know how you guys are actually doing. We're always happy to hear from you, and thanks for always supporting what we're doing at Economic Street, and we hope you're still finding the content that we're putting out very useful. Now,
definitely,
the reason we wanted to get back into the swing of things is because obviously a lot has been happening politically, socially, health-wise, across the world, and
economically, everything.
And all these have financial consequences. So we wanted to start just unpacking it for our viewers today, and just allowing you guys to understand a little bit more where you guys stand, especially going forward, and just being able to make better decisions, once you have the fuller picture and how it can really affect you. So today we've got quite a strong lineup today of topics that we wanted to discuss. We're going to be starting off with the UK and just what's going on in terms of current events and how that's actually going to play into your finances. And hopefully this discussion really helps you to start sinking your teeth a little bit more into just how the political landscape is shaping up to really affect the rest of 2020 for you and 2021 and beyond. Let's get into it. So today, Nick, talk us through what are our discussion points going to be today?
Yes, we've got a few discussion points, as you said. One of them is the potential impact of negative interest rates. Looking at bounce back loans. So bounce back loans will be coming to an end soon. So we'll be a brief discussion about that. Along with bounce back loans, we've got the extension of the self-employment income support scheme, which are both this and the bounce back loans were measures put in place to help with the COVID pandemic. Also this discussion about payment holidays and what's been going to happen with payment holidays, which is another implementation due to COVID and the current climate in the UK. Work from home expenses, and then you've got the looming impact of Brexit as well. So as well as 2020, we've had at the start of 2020, the big worry was Brexit, but then COVID kind of changed that perception, and it's kind of been put back to the back burner. But as we know, we're in October now. Brexit, the equivalence deal is going to be running out soon. So unless there's a deal in place, so that's going to be coming back to the forefront.
Wow! What a lineup we've got for you guys today. So let's jump into it and let's just start breaking it down for you guys. And we're going to start off with the Bank of England and what they're doing in terms of the proposal they're potentially putting forward to introduce what is called negative interest rates. Now, for our viewers, let's just break down a couple of key terms to give you a bit of context. So the Bank of England is a central bank in the UK that's responsible for essentially the financial and economic stability of the UK economy. Now, they do a couple of things in terms of in order to stabilize the economy. And one of them is the use of what we call interest rates. So they will set the level of interest rates, and this affects the cost of borrowing for banks, UK banks, and in turn, that would then affect the rates banks charge us for lending or pay us for saving money. So the Bank of England interest rate that they target is called the base rate, and this has huge implications for the rest of society. It affects trillions of pounds worth of loans annually, or billions and trillions. So it's very important for us to break down how this can impact you. So now that you know what the Bank of England is, let's discuss why they're potentially looking at introducing negative interest rates. Over to you, Nick.
Yeah, so the current actual base rate for the UK is at all-time low of 0.1%. So that's what the Bank of England has dropped that down to. But what they're looking and touching the waters for is to see if the banking system is ready for negative interest rates. And the question will be, well, why negative interest rates and how that can impact you? So as Ola kind of said, negative interest rate, or interest rates in general, have a big impact on the banking system. It determines what banks pay interest to each other, what banks get from the Bank of England. So basically, banks themselves hold their deposits with the Bank of England, because that's the central bank of the UK. So it has a wide-ranging impact. So interest rates is a key item that banks use in the financial system, or that the central bank uses in the financial system to help the economy. So usually it's used for helping with inflation. So the general premise is that if inflation is high, then what the Bank of England will usually do would increase interest rates to reduce inflation, because in theory, what that's supposed to do is help cool down the economy by encouraging people to start saving their money to get interest on their income, and in fact start to reduce the spending in the economy. And then the opposite if inflation is too low. But as we say, we're in a current economic crisis. And so what the Bank of England has done is they've reduced interest rates to its historically low level of 0.1%. Ideally, that's to help boost the economy, encourage banks to lend, and encourage consumers to spend more money. But what we're seeing is that the banks is potentially looking at going negative, because they think that although it's at a historic low, it might not be enough. As we can see in the news, COVID has just had a detrimental impact. So we thought the financial crisis was a big impact. That we remember graduating during those times, and it was a tough time. Yeah. But COVID has had such a bigger impact. So where the financial crisis was mainly affecting the financial system and the banking system, COVID is affecting everything, saying health, it's just had such a detrimental impact.
It's touching every aspect and facet of life and society.
Indeed, saying we've experienced that, saying being former students graduating into the economy, into the wider world, and that was a big impact for us. Where saying this is just such a monumental impact for everyone. So what the Bank of England's doing, they're sounding out two banks. I think they have until, I'm correct, I think it's the middle of November to reply back to the Bank of England. But basically, the Bank of England are sounding out to banks. Would they be ready if they were to correct? So basically, they're just sounding them out. Would they be prepared if they were to introduce negative interest rates? Yeah. As I said, that's never happened in the history of the UK economy. So can our computer systems even handle it? So there was a big uproar last year about the banking system and computer glitches and how banks, so quite a few banks got fined for having issues with their banking system. So what the Bank of England are looking to see is, can the banking system actually handle negative interest rates? Because it's never been done. So these are the things that are being sounded out. But what does that mean for you as a consumer?
I think before we answer that question, let's just give them a quick summary of the picture. So we're in a pandemic. Of course. We're in a pandemic. The government basically had to shut down the economy to try and stem the spread of the virus. Now, what that does is that when the whole economy is based and predicated on people being consumers like you and I, as well as businesses being able to essentially trade, buy and sell. Now, when they told people to stay indoors, people stopped spending money. Now, when people stop spending money, what that means is that there's not enough demand within the economy for goods and services that we're producing. And consequently, that would then affect economic growth. So ultimately, what can happen is that businesses can go bust, people can lose their jobs, and then it becomes a vicious cycle. So, and we're already seeing that a lot, especially on the high street. A lot of the high street businesses are going out of business. So one of the things that the government is trying to do, or the reason that they're considering introducing negative rates, is essentially to encourage people to borrow more money. Because if people can borrow money, or if firms can borrow money cheaply, that's the key there, cheaply, then they can spend that money, and one man's spending is another man's income. So that's how it goes. So if I spend money with Nick, that becomes income for him. He then spends it with other people, etc., etc. And that could almost, it acts as a jumpstart to jumpstart the economy again. So that is the emphasis for them wanting to do put this policy into place in the first place. Now back to your question, Nick. How does it affect? How is it going to affect us?
Yeah. So as I said, so that's the economic impact of the interest rates, as nicely put by Ola. But I said, as an individual person, how does that affect you? In the short term, it's unlikely to be a major impact in the short term. As I said, it's the Bank of England are just tested or are testing the waters with banks to see if they're ready to implement this. But also, if you are a mortgage, if you have a mortgage on a fixed term mortgage rate, so the mortgage rates are usually determined by the Bank of England base rate. But if you're on a fixed term mortgage, that's fixed, so you're unlikely to see any changes, even if negative interest rates were to be introduced.
So you're
But also, we have people that are on.
People that are locked in. Sorry to interrupt you.
No, go ahead.
With a fixed rate mortgage, people are locked in already. So
correct.
The base rate coming down or going negative is not going to change how much they're paying on a monthly basis on their mortgage.
Correct. And then that's the same if you're on a variable rate mortgage. So a variable rate, as I said, in term variable, it's not a fixed term. It will go up and down with the base rate. But variable rate mortgages in the UK have a condition that you'll never pay less than zero. So even if the interest rates went negative, your actual interest on your mortgage would never be less than zero. So you wouldn't get that benefit of then the bank needing to pay you in theory, because they've stipulated that you wouldn't.
They're not about to start handing out cash. Just
exactly. So in that terms, there's no impact for you. But then on the flip side, mortgages aside, say if you're a saver or you hold a deposit in a current account, in theory, if the interest rate went to a negative rate, you as a depositor into a bank would technically have to pay the bank to hold your funds. But from what I've been reading, what I've been seeing, that the transmission mechanism that we discussed, which is what banks pay the Bank of England and etc. pass on to us, it won't be passed on to us as a consumer. So it will be only on the bank's end. So i.e., what it is, the Bank of England would charge banks to hold deposits with them, but that won't be passed on to the consumer. So as Ola described earlier, what that should allow is to encourage banks to lend that money. So rather than paying the Bank of England to hold their deposits, it will try and encourage banks to then lend that to small businesses or even larger businesses to then use that as capital to encourage economic growth. And as Ola nicely described, one man's spending is another man's income.
Exactly. So that's one element of how it can affect you in terms of your mortgage. That's anybody that's on a property ladder. Also, actually, if you have existing loans, that could be anything from your car loan, if you bought car on hire purchase, or you have credit card debt, anything really, it can affect the cost of that. And on the flip side as well, it can affect the interest that you earn on your savings. So really and truly, if you got money, we already know that if you have money sitting in your current account, you're not really getting any interest in that.
we know that.
Exactly. But even things like a cash ISA, don't expect, rates are already low. So if them going negative now, you can't.
There's no change in that sense. You're not earning much anyway from, as we're all seeing, if you're a keen saver, you're not getting any benefits of just putting that account, that money into a savings account or a cash ISA, which is tax free. So even though it's tax free, they say that what you're getting on it is so minimal. It's kind of pointless.
Exactly. I think the most critical things for people to bear in mind is that if you're going to take out new loans or new borrowings, then that's where you can see quite huge savings over the long term being made.
Yeah,
I don't think
indeed.
we will get to the position whereby the banks are paying you to essentially borrow money, or do you think because that's essentially what negative rates means, is that?
Yeah, that's a good question. So as I said, at the moment, from what I've been reading and seeing, that's unlikely in the short term. But you never know. Say negative interest rates. It'd be a first in the UK, but we've had negative interest rates in the Eurozone for a number of years now, and also in Japan. Japan's had negative interest rates for a few decades now. So there is that possibility, but I think due to the transmission mechanism that we discussed, I don't think we'd be seeing that in the short term. But that's just my opinion. So it's a possibility, but I don't think that we'll be seeing that.
I mean, from my perspective as well, I think I'm in agreement. I don't think it will get to that stage whereby, you want to take out a mortgage and they're saying that over the lifetime of that mortgage, you're essentially going to be paying back less than the original amount they lent to you. Or if you take out a credit card, £10,000, now you're going to have to only pay back, I don't know, 9,500. I don't think it's going to get to that stage, but it's going to be very attractive rates from what's very attractive. And that could help stimulate the economy if people obviously start borrowing more.
Yeah.
The challenge economically with all these kind of policies is there's no way to really forecast human behavior. So people are already doubling down. People are struggling. Households are struggling. Some people are out of work. They don't have the income. So you're asking people that maybe don't have incomes to then borrow money. They may not even be able to access these loans, number one. And even if they could, they might just feel that that's just going to put more pressure on them financially.
No, I have to echo that. I was going to kind of sidetrack onto that. You hit a key point, is that, yes, even with these historic low rates, it's still trying to get access. So many people have lost their jobs. They're trying to get access to this capital. So that's another issue in itself. As in, even with the potential mortgage rate deals being more attractive, to be able to get them all is quite stringent to try and get them. Say if you're a first-time buyer, for example, it's quite difficult at the moment to get a mortgage. So unfortunately, it's like it kind of only would benefit you if you're lucky enough to have not been too badly affected during this current time. Otherwise, as you said, if you've lost your job or etc., it'd be quite difficult to then try and get access to this capital.
Yeah. So ultimately, I guess, well, number one, it's still up in the air whether they introduce this or not, and two, even if they introduce it, the ultimate outcome of it is still kind of uncertain, because one thing that people should understand is that something we say in economics is that there's time lags to anything you do. That simply just means that if I do something on day one today, it may not take me 2 or 3 years to see the full effects. And that's what could happen with this policy. We want to jumpstart the economy, but we may not see the full impact of introducing negative rates should we introduce them for a number of years.
Indeed.
So yeah, guys, I hope that's been insightful. We're going to take a short break right there, and then we'll be back. Shoot. Hi guys, and welcome back to the Economic Street podcast. Me and Nick are just chopping it up again, just discussing what's been happening recently within the UK economy. And now we want to just move on to our next topic. And our next topic is just looking at something called the bounce back loan, which is a specific government scheme that has been introduced during this pandemic to try and support businesses and keep them afloat. So Nick, did you want to just break that down a little bit more as to what the bounce back is for us?
Yeah, so as you said, we've been discussing earlier in the podcast, we're in this global pandemic. So what the government has trying to do is to help small businesses who might be struggling, is to offer what's called a bounce back loan. So what this is a government-backed loan where the government has encouraged banks to lend to small businesses. But the caveat of this is that it's backed by the government. So ideally, it's to encourage lending and to also protect. Well, I say protect banks, but that's a bit of a touchy subject. But yeah, it's basically the government saying to banks, okay, if this small business, because the fact it's as the name suggests, it's a loan. So if the small business was to default on this loan, i.e., not pay it back, the government will back that loan so that the bank doesn't lose out.
Yeah.
So I say it's a bit. No, go ahead.
No, I was just going to touch on that and just say it allows small businesses to borrow up to 25% of their turnover, up to including £50,000. So it's capped at £50,000. Now, when the government first tried to introduce a similar scheme called CBILS, which stands for Coronavirus Business Interruption Loans, they didn't offer 100% guarantees. So because they didn't offer 100% guarantees, the banks just basically said, no, we're not lending money. So the government
essentially.
The government just had to swallow it and just say, okay, we'll 100% guarantee it. And as soon as they said that, floodgates opened. And a lot of businesses started taking out the loans. People just started taking out the loans. It's even helped me with a couple of my businesses. So a lot of people, if you don't know that I'm an accountant by day, I also run a tuition services called the Economic Street. Called the Exam Success Company. I'm mixing it up now.
Yes, Mr. Businessman.
Yeah, yes, businessman. So yeah, and I run an accounting firm called Greenfield Accounting. So that's a little bit of a shameless plug there. So I had to make use of these schemes for my various businesses, and I have firsthand experience in terms of that process of applying for it, and just the relative ease of the entire process to getting those loans. Now, in terms of actually, like you said, Nick, it's a loan. You're supposed to pay it back over 5 years. So the first year that you take out the loan, the government will cover the interest, and then you have another 5 years to then pay it off. And it's good. It's attractive. The rates is 2.5%. So in this economy, that's not actually bad if you've been able to borrow up to £50,000 at that rate. So how do you think, what do you think this can help do in terms of stabilizing the economy or just helping the everyday man?
Yeah, I think so. The idea is so many businesses have been, especially small businesses, have been affected by the current pandemic that we're in. So in theory, what it should do is help to smooth out the peaks and troughs that firms are going through. So what I mean by that is that it's kind of difficulty to be making money at this current time, or you still as a business yourself might have expenses that you're still needing to pay back. But what the bounce back loan should allow you is to try and get through this pandemic as easy as possible. So some even argue it's still not enough, but this is what the government has put in place. And I'm saying, I mentioned earlier about it being backed. It's a bit of a touchy subject in terms of, because of the financial crisis, a lot of people still blame the banks for the predicament that we got into for that recession. So now that the government's still then backing it, essentially the government's writing a blank check to help out the economy. But I do think it's a good thing because small businesses are needed to help run and propel the economy.
Yeah, they are the drivers. That's the funny thing. They are the drivers. They're the engine room of the economy. A lot of people, because we only hear about the big firms, the big companies, I think those are the companies that actually employ the most people in society, but it's actually small businesses that employ the most employees across the entire nation. And that's why the government is particularly keen to kind of support them and just make sure that as many of them, not all will survive, but as many of them as possible could survive this period and crisis that we're in at the moment. what were you going to say, Nick?
Go ahead. No, I was just saying as well, if you are a small business and haven't taken out a bounce back loan yet, do look into it, because I believe it ends on the 30th of November, where the government's going to be ending the scheme. And also, I know some firms are also not participating in the bounce back loan. However, you don't have to take out the loan with the bank that your business banks with. So that's another caveat. So you can look around and shop around for this bounce back loan. But yeah, just be aware that it is coming to an end.
On that last point you made, I would say you need to get a move on, because what happened, as I said, the floodgates open, excuse me, and the banks were inundated with thousands of applications, literally tens of thousands. Mm-hmm. So literally, they even started putting stipulations in place that if you don't currently bank with us, we're not touching you, or you're getting put on a waiting list, and that's been happening with a lot of people. So there's probably still a handful of maybe banks that may allow you to go through the process with them. The best starting point is just to go on the British Business Bank website, or just type in Google, and it will direct you to the list of lenders, accredited lenders on that list. And in the meantime, if you ever need an accountant, I'm your guy.
He is indeed. He is.
I'm your guy. If you're anything off the back of a truck, yeah, I'm not your guy. So yeah, but no, it's good. It's good to just let people be aware of the options that are available to them during this period that we're trying to navigate through. And I guess then that brings us to our next point, right?
Yes, I was about to say. So on that, there's other people in the economy, another section of the economy screaming, "What about me?" And that's the self-employed. So that's the people that are your self-employed people that are helping, or also drivers of the economy, but they're not set up as a business function, but they're set up as a self-employed person. And what the government did for the self-employed is they introduced the self-employed income support scheme, which it provided a taxable grant worth up to 80% of the firm's profit, up to a cap of $2,500 per month. So that was introduced in March, and then over the summer, you got a second and final payment.
So just say that again.
Say that again. So
you're just cracking up. So say that again.
Yeah. So sorry. So what we've got, another scheme that the government introduced was the self-employed income support scheme. Yeah. So this was for the self-employed people in our economy. So what this did, it provided a taxable grant with up to 80% of the firm's profits, up to a cap of $2,500 per month. However, a caveat of that is that a firm had to have filed a previous tax return. So if you're newly self-employed, you wouldn't have got access to this scheme. But if you've previously submitted a tax return, you can get access to the scheme. And another thing which I didn't realize at the time actually is that also your profits or revenue from self-employment need to be over 50% of your income. So if it's not over 50% of your income, unfortunately, you can't get access to this scheme. So if you are newly self-employed, or you're quite a small self-employed one-man band, unfortunately, you can get denied access to this scheme, which is a bit of a shame. So initially, when it was introduced in March, as I said, it was £2,500 per month. Yeah. And then you got a second and final payment covering 70% of your profits, up to a cap of $2,190 per month for another 3 months, for a total. Now go ahead.
When does that end?
Say that again, sorry?
When does that end? Because we had the first.
Yeah, sorry, apologies. Yeah, so that was in March. Then you had over the summer. And then what's happened is the government actually is now extended it. So originally it was from March until the summer, but now they've extended up into at the start of November. So with this though, it reduces quite significantly. So now from November, it will be 40% of your average monthly profits, up to a limit of 3,750. And then this one will be paid out as a single installment that you'll get. So they've extended that for people that have not taken advantage of this yet. So please, if you're a small business, do look into the self-employed income support scheme. And it's just saying it's just another way of getting access and getting help during these difficult times.
Exactly. And then there's also, now that everybody's pretty much working from home, most people are working from home. There's something else
Yes.
I want to let you guys know about. And yeah, this is a little Christmas present for you guys. Go for it, Nick.
Yeah. So basically, it's work from home expenses.
Yeah.
So what that allows is for the government are now doing that, regardless of when you work from home, they're now covering your expenses for the whole year. So whether you work from home for one day during this year or for the whole period, what they're allowing is you to claim back these expenses. So what that is that you
Not
can
all
claim
the
back.
expenses. There's a
Yeah, about to say, yeah, there's a caveat in that. So yes, so or you can claim back all your expenses. However, you need to provide proof and documentation
yeah.
to claim back a greater expense. But what they're basically doing, without you needing to provide any proof, you can automatically claim back £6 per week,
£6 per
which
week.
is per week. Yes. So if you're a basic rate taxpayer, that works out to be £1.20 per week, and if you're a higher income 40% tax rate payer, that's £2.40 per week across the tax year. So I say it's not much, but in these times we know every little helps.
It's
And
at
you
least
just say there's no proof needed.
exactly. And what people just have to do, you have to fill out a self-assessment, what we call a self-assessment tax return. If you're not currently registered for self-assessment, you're gonna have to get registered. Easiest way, go on, just type in Google self-assessment, register, HMRC, something like that. It will come up. Or give HMRC a call. They'll be happy to help you. Or holler at your boy for a fee. I can do it for you as well.
And then also, yeah, that's through a self-assessment, or if you're employed, you can actually do it through, so you can type in that same details and you can fill out a form, and then basically it will be done through your pay EYE system.
Yeah.
So basically it will change your tax code so that your company that you work for would then know what tax you should be taking. So basically it reduces your tax rate.
Yeah.
So these are just little things.
And this is for the 2020-21 tax year.
Tax year.
We start from 6th of April to 5th of April.
Correct.
This is the lockdown started March 23rd officially. You can actually also claim like about 2 weeks worth as well.
You can, yes. That's correct.
As well. So yeah.
And then on this topic saying of things that have been implemented during these COVID pandemics, you've got the payment holidays. So payment holidays were introduced to help people that may have lost jobs, couldn't work because of lockdown. So what that was is that if you had mortgages, bank loans, any kind of borrowing, you could take a payment holiday from paying these to help ease your income. But a caveat of that is that you needed to you couldn't just say, oh, I'm not going to pay it then. You had to have actually discussed with your lender beforehand, because you had some people that actually didn't tell their lender.
They just stopped paying it. They just stopped paying
exactly. Which the detriment to that is basically that has a negative impact on your credit report, because that goes down as missed payments.
Yeah.
So what the payment holiday was introduced for is to basically allow you in a safe way to defer your payments and not affect your credit file. However, interest will still be applied. So you could defer your payment, but you'd still be charged interest on your credit card, on your car loan, on your mortgage, etc. But it just meant that you didn't have to pay if your mortgage was £1,500 per month. That saved you £1,500 for that month. Actually, it went up to 3 months, so that's how long you could defer that to. But the reason why I bring up the payment holidays is that this is actually coming to an end at the end of October. So what that would mean is that you have to basically go into separate negotiations with your lenders about any specific payment holidays.
Yeah.
But also what it potentially means.
Government scheme that says
yes,
this you can do it. Yeah. Now you actually have to approach. Well, you have to go through that negotiation process now, right?
Yes, and then also with that though, there's no guarantee that they may not leave imprint on your credit file now. So what I mean by that is that, yeah, you may still get the holiday, but they don't have to say that they won't put a negative mark or a missed payment on your credit file, which is a bit of a shame. So it's a kind of double-edged sword. On one hand, they're still kind of giving you help. On the other hand, they'll say, well, you're still missing payment. So why that then impacts you is that because it's leaving a mark on your credit file, if you needed to get any borrowing in the future, any potential lender can see that on your credit file, and that usually has a negative impact if they see that you're missing payments. So that might be a signal to them, is like, okay, I might not lend to this person because they're missing payments, or I may lend to you, however, I want you to pay a much higher interest rate. So
that's the thing.
It's that double-edged sword.
It's you're stuck between a rock. You're kind of caught between a rock and a hard place, because I mean, nobody wants not your financial well. I don't want to say your financial well-being is predicated, but the basis or the foundation of your financial journey is a good credit rating. And if that's gonna have an impact on your credit rating, then this has ramifications for other things that you may want to do in the future, like getting other mortgages for other properties, or getting a loan for a car or anything else. And even if you're successful in getting that loan, maybe at a higher cost. So this is something that you just have to weigh up if you're in that situation where you do feel that you need to take that extra payment holiday from your bank. Just be aware of it and just talk to them and see what their own specific conditions are as well.
Yes, because I said it's not blanket no more. It will be talking to each individual lender regarding what their policies and procedures are.
Cool. Nice one.
So no, go ahead.
Yeah, I guess that's just a little catch up for you guys. I hope you found that useful. We'll be back regularly now, so we're back to the regular scheduled programming. We just took a bit of time off. Let's just actually let you know what we've been doing behind the scenes. What we've been trying to do for a while is build what we call a learning management system that allows you to then take courses at your own pace across different financial aspects, from just basic budgeting to understanding more about the investment landscape to property investing. So that's what we've been trying to do behind the scenes, and that was why we were not producing as much content or churning them out regularly as we used to. But we're back now. We're going to try to be more consistent, aren't we? And as you can see, we've got the merch. We've got the fitted. Nick is sporting the hoodie, and hopefully we're going to be setting up a shop soon, so that you guys can support and get some of the merchandise as well. We've got mugs as well. So yeah, it's a well-rounded. But any final comments or any final thoughts from you, Nick?
Yeah, I just want to kind of echo what you said. As I said, we want to be back on a more regular basis, providing you guys with more of our input. As I said, we were going hard on this before, but we're saying we've had things in the background that we've been working on and want to bring to the forefront, but also want to be back and providing our listeners with key content that they can break down and digest. Super. On that note, guys, thank you for tuning in. Please like, share, subscribe, but most importantly, just spread the word, man. If you like what you see here today, share the clips, share the post, share the content with other people. Yep. And always drop your thoughts, your comments, and your questions with us. You can send that to us on our social platforms. All our social platforms are at Economic Street. One word, Economic Street. So you can find us. We're primarily on Instagram, but we're on Facebook as well. We've got a Twitter page. We don't use that much. We're not hard to get. We're not hard to get hold of. That's what we're saying. Yes, so, indeed. Yeah, don't be a stranger and don't be shy. We're always happy to hear from you. So yeah. On that note, guys, until next time. See you soon. Speak soon.